Eric Mother, Mother.com, with another mentorship video. Let's take a look here at how markets are trading with about 1 hour of trading. Last trading day of the week for the first week of 2016. We can see we've been up, we've been down slightly. We did make an attempt to go below zero, but the market has held. Just want to discuss a couple of things and take a look at your positions. Let's begin by taking a look at the Nasdaq daily. And what we have here is yesterday we had this big plunge. Hope you can see that. Today we are gapping up slightly, and you can see yesterday while we were moving lower, the daily RSI moved below 30.9. So that was a reason for this big drop. Today we are seeing the market on the Nasdaq at least move back above 30.90. So which indicates to me that as long as this is holding above 30.90 for the day, chances are the market is going to hold this gain, probably even a bigger gain into the close. That's generally what I'm trying to get at here. And also we can also see this type of evidence if we take a look at the Dow daily just for the day. And watching these numbers, sometimes the key here is knowing where the RSI levels are does give you some reason not to panic, because right now you do have some short positions. And so based on the fact that even the Dow daily is moving above 30.90, if you see the market move higher today, you should not necessarily panic, because you know that means that's a positive close. Nothing goes up or down in a straight shot, so we can at least take a little bit of a hit if this market is moving high, and that's the key. I mean, this is a big drop coming into the new year. A little bit of a slight move higher does not mean that the market cannot still eventually go and break these lows or these lows. So there's a lot of work. We just began the new year. There's a lot of trading to be had this year, so just no need to panic in and out of any position or to be looking to change sides just because of one or 2 day going against the grain. So anyway, for the day, what I want to point out here is what the Dow is doing on the daily chart. Let me mention the Dow monthly just for a view of the month. Take a look at what the Dow monthly is doing, and we can see for the month of January now we are moving below 50, which suggests that net this might be a big down month. Of course, we don't know. The last time we had a move below 50 was here during this month of August, and we know what happened August of last year. The market had this sizable drop right there, and so we are seeing the same move below 50, and that is a reason to be a little bit skeptical of what the market is trying to do in terms of whether it can hold even with bounces along the way. We can also see that the main MACD is also moving to 3-year lows. That's not a good sign. We can see the secondary MACD was rejected exactly at the zero line. That's another bearish signal of month-to-month action. For this month also, we can also see the possibility that the Dow could, who knows, eventually break the lows of 2015 on a monthly closing basis, and could also go on to break this low here. So given this scenario, and let's take a look at the Dow weekly. Actually, let's take a look at the S&P 500, so SPX. And the monthly for the S&P 500, just take a quick look here, and we can see that this is a scary looking chart for anybody who's been trying to find a bounce in the market. Take a look at the fact that here we are seeing the main MACD at 3-year lows. Secondary MACD was rejected at 0, which is not a good sign. And also we can see here that the secondary MACD could easily move to fresh 3-year lows. So the MACD being rejected at 0 tends to suggest that there's no momentum to take it higher short term. So just keep that in mind. So I don't know whether we've discussed that before, but this rejection at 0, uniform activity above 0 and back below it, is a sign. This uniform activity is a sign that the market gave up the idea of moving higher, and now of course we are seeing the exact opposite. The more the market stays below 0 here, the more month to month markets are going to be bearish. S&P 500 also, as of right now, jumping to 3-year lows, and the key here is whether it can hold above or below the 50 level on the monthly RSI. Anything below 50 and this market is going to have a substantial drop for this month or the month whenever it cracks below 50. For the week, as I mentioned earlier, the problem here for the week is the market slashed below 50. It closed the year slightly above 50 on the S&P 500, and this week we are moving and slashing below 50, and that's why we are getting this this nice move to the downside. So yes, if we take a look at the S&P 500, it is holding, it never went below 30.90. So there's some type of, a little bit short term, you can say there's some type of supporting action here on the S&P 500. And in fact, if you're really trying to push the agenda here, if you draw a line somewhere around there, just slightly around, just slightly above 30.9, what you see here is a support here during these lows, and we came close here for those lows somewhere there, here for the lows there, double bottom for the lows there, uniform activity below the green line and back above it for the lows here, support here, entry there. So what I'm getting at here is if the market eventually does move back above this green line, something like that, then maybe there might be some support right now. But the risk is the monthly charts look absolutely scary. Also here on the weekly, on the daily MACD, you can see uniform activity above zero and back below it. That's a sell signal, and rejection at the zero line recently as we ended the year. Another reason why the market has been pulling back. So a lot of the indicators we are watching here are still pointing to a market that is struggling. Now I want to touch on the VIX. The reason why I bring the VIX up is because the VIX is trading at 23. And whenever the VIX is trading, let's call it at about in the 20s, let's just say 20s, in the 20s, the markets tend to be, the general market direction is so volatile, it is hard to see, to make, at least to make have an idea of what the market is trying to do, just because of the volatility and the movement. The movement is so all over the place. But what we can watch here is for your short ideas to continue working, you'd like to see the VIX break out above 24.39, which is this recent weekly closing high. If it can do that, that's great. Now I see a little bit of a problem with the VIX right now, and it is on the daily chart, just because if I take the line connecting the highs like that, you can see that it connects nicely with the last three major highs on the VIX. So as long as the VIX is showing resistance on this line, we should not be too surprised to see that the VIX might actually start trickling down while the general market moves higher. So the VIX could go lower as long as we are seeing resistance here. Now keep in mind where the RSI is showing resistance, just under 61.8, if not exactly at about 61.8. So the problem here is that the VIX is showing resistance. So if we draw that line right there, you can see that the major highs in the VIX over here, this is uniform activity above 61.8, which is for the highs there, and then again there's a slight rejection there, which is the high there, and here we came close for the highs there, we came close here for the highs here, and again we are seeing that taking place. So the key here is as long as the VIX is struggling to hold above 61.8, the more the VIX struggles to hold that level, the more the VIX drops, and the more the general market rebounds, and the more the short ideas you have on might not work. So we can watch that for direction. And so because the VIX is elevated, I wanted to take a look at the SPX. So when the VIX is above 20, I have no problem looking at the 5-minute chart. Remember, you don't want to use a 5-minute chart every day. You want to use it only when markets are really volatile and the VIX is elevated, because this would mislead you. This is a 5-minute chart, so a 5-minute chart is only good for the next couple of 5-minute periods. So you can't use it for long-term really trading, So just be aware, we want to use the smaller time frames more and more, the more the VIX is elevated. Right now it is at 23 and change, so we can still look for some guidance. If you take the highs on the 5-minute chart on the RSI, you can see at the open of this session when the market was up, I think 120, about 200 points higher, I believe. I don't remember. Anyway, at the highs of this morning's action, the market hit that level, which is somewhere here, and now we are stalling. So clearly, this is what I was getting at. And until such a time that the general market or the S&P 500 can move above that blue line, this market is still gonna be moving lower. So let me repeat that. Because we can see a clear line of resistance on the S&P 500 5-minute chart, we can just draw this line and make a commitment that as long as the markets are trading below this blue line, we should still expect a pullback. It's only when the market finally clears above that line that we can start probably giving a serious look as to whether we want to get out of those short positions for now, or maybe at least take a little bit of a tiny profit and let the rest of them trade as they may. So just watch that for short-term direction. Right now, what I'm trying to say here and impress on you is, because it is below, we are trading below the blue line, we should still expect the market to be pulling back and your short ideas to be also working out. So let's take a look at the ideas that you have, the positions you have open right now on the short side. You got EUM, EEV, and DUG, right? So let's take a look at those, and they all look great. We take a look at EUM, and we can see that right now it is breaking out even on the weekly. So you went long this one based on this breakout here, and we can see that it continues to trade well. So there's really no reason. The one thing I was going to suggest is, maybe because we don't know that eventually they fail, it is not a bad idea to sell a couple shares just to protect yourself whenever you might be forced to take a stop. So let's say your stop's going to be at 5%, and so what you can do is sell a few shares now that you have a slight move, if you want to, that is, and see whether, if it eventually fails, so eventually if it comes back to trade below our buy point here, and you get stopped out at 5%, by selling a few shares now, this 5% is actually going to be smaller than 5%. So in other words, you're just buying a little bit of insurance should you ever have to be forced to take a small loss on the position should the market decide that this is not going to play out. So here we are seeing EUM break out convincingly. We take a look at and the key here, why I love this, is because you can see here that we are moving, and this is to me the best way of finding ideas that have inbuilt momentum. If it's going to work out, this is when it's going to really explode, because it's also moving above 61.8 for the first time ever, which is what we really should be concentrating on, and RSI at 3-year highs. So in terms of the technical picture, the stocks or the ETFs look perfect. Whether they're going to deliver is another issue altogether. So that looks good. Wanted to mention the weekly. You can see that the weekly here also broke out above the recent weekly closing high. So there's another weekly breakout. As long as all these weekly and monthly breakouts are taking place, I don't see any reason to get out of that position. It still looks good. Take a look at the other idea, and it is EEV. And again, here we're looking at this ETF. I don't know that you recall this, but we had gone long during this breakout a couple months ago. This breakout here from about under 20 all the way to this $30. So about 50% gain, about 2 months. That breakout worked pretty good, and now we are seeing another effort, another breakout attempt. The key here, and the reason why I really have been insisting on this for now, is because they're also moving above 61.8 on the monthly and making 3-year highs, and we can also see that here the MACDs are also trading at 3-year highs. So I mean, unless you're really being very picky or this, but what I'm getting here, we're just looking at stocks or ETFs that are just acting well. Here above 76 was the buy point and still looks good. And we had also gone long this one here a couple months ago during this breakout, and we can see here that maybe this is not one you want to hold for 10 months. This is probably gonna be a couple months, couple weeks holding period at best, because they spike and they cool off. And that's the key with the bear ETFs. They spike for a couple of days, couple weeks, couple months, and then they cool off. So we don't, this is not going to be a long-term holding period here. The RSI looks good. So RSI looks good here, and MACDs are acting well. So I think what I would try and suggest here is, because the stocks that you own all have moved a little bit higher since you bought them, the key here is just take a little bit of a profit, just a little bit. Like maybe if you have like 100 shares, sell 8 shares. And what this does is, eventually if you have to take a loss on the stock, it's just going to make your stop loss a little bit smaller. So otherwise, I leave you here, and markets still volatile. They're going to be volatile all session, because you're having a VIX that is trading above 23, and we go back to those daily charts for the NASDAQ just for the day, because here's the thing, if you understand what the RSI levels are suggesting for right now, we are seeing the Dow or the NASDAQ, and if it can still continue to holding above 30.90, it might have a chance of having a strong day. So we can watch that, and take a look here at the Dow. And we take a look at the Dow here, we can see it is holding above 30.9 even as of right now. So don't be surprised if this day turns into a strong day for the market. And the reason why I want to bring that up is, let me just go and explain why. Let's take a look at a long-term monthly chart for the Dow. Okay, if you understand what the markets are doing above, as they move above 30.90, you respect the potential. So for example, here in 2008, during this period here, the market was moving below 30.90, and it stayed down until it moved back above 30.90, which is somewhere here. So that movement is not trivial. So if you see this on a monthly chart, you know that this might be good for many months down the road, and so we can't ignore these types of small things. So what I'm saying is, for example, take a look at this period here in 2003, when the market held at 30.9. So this is almost similar to what the Dow and the NASDAQ are doing right now. They are holding after one day below 30.90, the next day they're jumping back above 30.90. So this, what I'm getting at is, this could be a period where the market eventually does start moving higher. Now, since we have this chart here, I was going to talk about the stock you mentioned, I think the other day when we were talking, it was GE, and the fact that you bought it in 2008, somewhere, I would assume somewhere around there. And also here we can see, if you had used the RSI, you can see that once it moved below 30.90 here in late 2008, it plunged, and it's only after it recaptured the level back above 30.90 that it started moving higher to somewhere there. So we can see that we can use long-term monthly charts to get us an entry. Now let me draw another line here. Let me draw a line here, and this is uniformity stuff. So we see this now, this movement in 2002, 2003, this movement here on G led the stock to a nice move from the lows here, right? That was a nice move. And so we can draw a line from there, and this line is packed with a lot of information. Take a look at the break below the green line there. That break was G breaking down here before it plunged from 22 all the way to $5, and then it finally moved back above. So it moved back above that green line here, which is this period here at about $10 or so, and since then it's gone as high as $30. Now the key, I don't know whether you can see that, but I'm gonna show you, is uniform action. You got this breakout here. So we know that we are using the stock's own behavior, which is this behavior here that it recovered. We are drawing a simple green line there, somewhere around there, and you can see that this by itself is almost uniform action. It is not perfect, but it pretty much looks something like this. So that's the green line. So that's the green line, and what's going to, it did something like this, generally speaking. And it is not perfect, but it is like a V-type uniform action. So once it moves back above that level, which is here, and you've seen the uniform action, it generally suggests that now it is time for the market to start pushing it higher. So just wanted to take a look at that. Also, take note of the fact that the secondary MACD here also had uniform action. In fact, you can even split this in half right there. You can split that in half, and you can see once it recaptured back above the zero line with that uniform action, so that recovery there corresponds with the movement there and the RSI movement there. So all these things play out. Just want to touch that because you mentioned that, and as of right now we're looking at G struggling, because if you take a line connecting the highs, it should look something like that. It connects the highs throughout this most recent highs on a long-term monthly chart. So we can see the pullback here is just the beginning, in my opinion, for this instrument. Otherwise, I'll stop the video there, and just for the sake of the market here, and because sometimes it's good to study markets intraday, because the more you use the hourly charts and the 5-minute charts and understand how the RSI and the MACDs all work in relation to each other, now you can take that understanding and use it on the bigger time frame. So one thing you can do is just use the dailies, hourlies, and the minute charts to understand how markets trade on a big time frame. So I don't think there's anything wrong in trading markets short term, or at least watching them short term, if the idea is to understand how markets trade on a bigger scale. For example, take a look at this 5-minute chart for the S&P 500. So we saw that at the highs of the day, the market hit that level and pulled back, right? We can also see this type of action if you take a look at the S&P 500 weekly. And the weekly also has a top side resistance. So the same thing happens on small time frames, and it also happens on big time frames. Eric Mwadid.com. As always, good luck, peace, and blessings. ERCS. Whoa.